2015, the year the Federal Reserve finally moved on rates. Will 2016 be the year the Bank of England moves? And what about the ECB? Then there's China, still struggling for a foothold with rate cuts. Well, joining us to discuss what to expect over the next 12 months when it comes to the macroeconomic outlook is Russ Mould, Investment Director from AJ Bell. Thanks very much for coming in. There is so much happening with the central banks. I mean, it's basically that's the big driver at the moment, isn't it?
They've been centre stage for the last, 5, 6, 7 years, and they're likely to still, regrettably, in my opinion, be centre stage in 2016. As a stock guy, it's much more fun to talk about individual companies, but in the end, at the moment, sentiment's been driven by those central banks and policy divergence, as you said. The Fed has already moved, at long last, after impersonating Hamlet for about 18 months, and now it's a matter of, will the Bank of England follow them? And I guess the market's current expectations, is second half of 2016 at the moment? But I know there are some people out there who think the Fed won't actually do its forecast 4 rate rises next year, but will actually go back the other way and start cutting again.
Well, that really would be a turn up for the books.
It would be an amazing turn up for the books, given that the consensus, which I personally would agree with, is long dollar, because the Fed is, the US economy is probably the strongest there is. Might not say much, but on a relative basis, it probably is the leader. And I think that is a very firm underfooting for the underpinning for the dollar. And will the Fed do 4 rises? Nah, I'm desperate. I actually thought they might not even bother this year. So I
think they had to.
I was very nearly right. But I think they had got to the point whereby, frankly, they'd led the horse to water, and they just had to almost to protect their own credibility. Normally, central banks raise rates to choke off inflation and credit growth. They don't want to do either right now. So in that respect, it was quite an issue. It was almost credibility, and perhaps they're paying attention to concerns over asset price inflation and the possible ramifications of that.
The question is, of course, is the US economy, will it, over the next 12 months, be robust enough to sustain not just its recovery, but world trade?
I think the fact that the Fed has putty-footed about for the last 18 months tells you that they have their concerns. And I think you've got to be careful looking at manufacturing and services quite distinctly. Services looks to be doing OK, though I accept the PMI services number this week wasn't great and actually slowed down quite a lot. Manufacturing is definitely not enjoying itself. If you look at all of the PMIs, not just the national one, but the regional ones, Dallas, Kansas, Richmond, Empire State, Philadelphia, they're all virtually negative territory, particularly for new orders, particularly for pricing. Export numbers aren't great, trade numbers aren't great. The Dow Jones Transport, it's down about 15% from its peak. So on the manufacturing side, it's not a good picture, and that's why you've got Intel, J&J and all those guys squealing about the strong dollar, and that's one thing that I think will give the Fed pause for thought in 2016. The dollar's tightening policy and credit spreads are widening. That's tightening policy as well, with or without the central bank.
You're talking about trade, because then you've got, on the other hand, the world's largest trading bloc, Europe, the ECB, going a completely different path to the US.
Full tilt.
Well, exactly. How does that then impact things?
Well, I think it's great for the European Central Bank if the Fed does keep raising rates, because it should, on balance, deliver them a weaker euro, which is exactly what
Mario Draghi wants.
Exactly what he wants. I know the Fed's just had its worst, the dollar's just had its worst month for about 8 months, but only after a sensational run, and I think that's just a classic year-end closing positional thing, and also, buying the rumour, selling the fact, right? So I think in that respect, I don't think the fundamental dollar story is unchanged, but the ECB is currently getting exactly what it wants, except, of course, huge amounts of credit growth, which is what it's doing its best to stimulate, but it's almost a prisoner's dilemma. The more Mr Draghi provides in terms of breathing room for European countries to get their house in order and drive through those reforms that they have to do, the less able or willing they are to do so. Hence Matteo Renzi, the Italian Prime Minister's complaint to the Financial Times this week. Austerity, there's a big move against it right now. You're seeing it in Spain, you've seen it in Portugal, you're seeing it in Greece. It's, in some ways, the more time Draghi buys those countries, the less willing they seem to go down that path.
What does all that mean? You said right at the beginning there, for a stocks man, you want to be focusing on the stocks, but there's the central banks that are really taking charge. What does that mean then for you as a stocks man?
As a stock man, it means that you're looking for anything that can generate sustainable organic growth, because we're in a low growth / no growth world where rates are going to stay lower for longer, and because rates are going to stay lower for longer, huge premium still on income and dividend generating stocks, which I appreciate from a trading point of view isn't very sexy, but from a long-term investing point of view, it's still absolutely cast iron. But it does mean you've still got to be very careful. 8 FTSE 100 stocks have hinted at or suggested they'll cut their dividends in 2015, and there's 21 FTSE stocks offering yields of around 5% or more on consensus forecasts. When the 10-year gilt's less than 2 and cash is 0.5, I think some of those will prove to be too good to be true.
If you were to pick one for you at the moment that stands out.
That's too good to be true.
Too good to be true and that is good.
Too good to be true, BHP Billiton and Glaxo, I think, are two that absolutely stand out. I think on the solid side, the cigarette stocks, I know that, again, they're a bit dull. There's plain packaging on those issues, but I think at the moment they have the pricing power that they need, and I think they'll still be fine in 2016 and beyond.
Is it UK at the moment that you think, I mean, you are a UK man, but is it UK that you think is the focus, should be the focus?
Not particularly, no. I mean, the UK has been a horror in 2015.
We're
It's
down,
it's
5%?
down 5-6% when you've had Japan up in the teens in local currency, Europe up in the teens, Italy up in the teens, US kind of flattish. I don't think the UK will be the big focus in 2016 because it's got this ghastly mix of mines, oils, banks and pharmaceuticals that don't really help it very much. The focus will be on the US, which has kind of flattened off a little bit. And the big story, I think the value is emerging in emerging markets, but whether 2016 is the time to absolutely, stick onto your courage and get involved or not, I don't know, but that's definitely where the value is starting to appear, I think.
What are the biggest challenges to then the UK equities?
Biggest challenges are the fact that it's very heavily reliant on oils miners and banks particularly. I think the UK economy is doing okay. Again, manufacturing's finding it a bit tougher because sterling's been quite robust. Services bobbling along quite happily. But yeah, the fact that you've got something like 50% of your earnings coming from those four sectors means, including pharmaceuticals, means it's not the most exciting mix, quite frankly. If anything, the good news is miners are slowly becoming less influential, but there's still 7 left in the index. So I wouldn't necessarily want to get too excited until that number's gone down to maybe 1, 2. Then I'd be really interested because everybody's given up on it then. So maybe when you've got Rio left and maybe BHP scrabbling around, the others are all out the back door.
That's the time to begin.
I think then the wet towels come slopping into the ring, hasn't it? I think everybody's given up then.
If you could put your neck on the line, the FTSE in 12 months, we're sitting here, what are we looking at?
Where it is now.
Okay.
6,150, 6,2.
Okay, I'll leave it there.
Pleasure.
But, thanks so very much, Russ Mould, there from AJ Bell. Looking ahead to what we can expect on a macro viewpoint for 2016 and indeed then what that means for your investment strategy.